Welcome to our reading on financial reporting quality, red flags and accounting warning signs. Now I have to say that if I was studying CFA Level 1, I think I'd be leaving this to the end of my studies. There's a lot of learning, there's a lot of stuff that you'll read now and then forget again. The good news is there's nothing difficult here and there are calculations whatsoever. Seasonality. Again, it could be an indication that this sudden earnings spike that we're seeing has been arrived at fraudulently. Equity accounted or unconsolidated special purpose entities. Now, these should not really exist now under US GAAP. The US GAAP, as we said prior to the Enron scandal, used to allow equity accounting for special purpose entities. What that meant was if you were you made sure you weren't the majority shareholder of the special purpose vehicle, and that allowed you to equity account. What that meant is you brought in your share of the net assets of the special purpose vehicle. So you could net its assets against its liabilities and then bring in your ownership percentage of that figure. Now the problem with special purpose vehicles is they are very thinly capitalized. In other words, the asset figure and the liability figure, liabilities are only a tiny bit smaller than assets. So when you look at net assets, it's a minute figure. So you'll be bringing in your share of a minute figure. Now the problem turned out in situations like Enron is that they were equity accounting even though they had the full exposure to the risks of these special purpose vehicles. And that's because they'd cross-guaranteed the liabilities that the special purpose vehicles had issued. Essentially, Enron used a lot of its special purpose vehicles for asset securitization. Now, because it had full exposure to the liabilities, what we should have said is Enron has all the risk. They should have been acquisition accounting, which means take the assets and add them to Enron's assets, take the liabilities and add them to Enron's liabilities. None of this netting off assets against liabilities. Now, as we said, equity accounted special purpose entities now are just incredibly rare under US GAAP. They've tightened up. They now say if you have the risks and rewards, I don't care how many shares you own, it's your subsidiary and you must acquisition account it. In particular, we should look for special purpose entities that are very uncommon for the industry because, number one, we need to say, well, what the heck are these things? What are they being used for? Why did the competitors not have them, but this company has? If we'd done that maybe with companies like Enron, we might have been questioning what are all these special purpose vehicles doing. There were certainly some strange ones. There was one that contained the asset transferred from Enron to the special purpose vehicle was an intangible power station. Finally, excessive off-balance sheet financing. Now, we've talked about operating leases, but we have a number of different forms of off-balance sheet financing that exist, such as take-or-pay and throughput agreements. Now, the SEC has increased the amount of additional disclosure it now requires for off-balance sheet financing. And that's the end of our reading.